All right, DAX. I'm going to start looking at European indexes, however you want to call that. Spent a lot of time on U.S. markets, some Canadian. Maybe that's going to be after I do my little world tour of indexes. I'll come back, finish up with my homeland's TSX index. But I'm trying to do some history building, some understanding of what has happened worldwide outside of the U.S., how correlation worked with certain indexes, how much some follow more the U.S. and others. And look at that, man. People could have seen this here and say, man, we've gone exponential. Look at that. That can't be sustained. But after that, when you zoom out, yeah. All right. So let's start digging around. And remember 1982, November 1982, they had the buybacks were rendered legal with a few little quirks, 4 little rules. Companies in November of 82, they could start doing buybacks. And look what happened here, guys. And this is December, so November legal. And the next month, bam, broke out of that base. Multi-year base. That's it. Adios, muchachos. And look at that green. Bam, look at all that money going in. Just insane. So after 10 years of just not doing anything, sideways move, buy and hold, not giving you much of anything, it just exploded. Just like the States. Just went skyrocket. I'm so curious. Let's see. Let me put the SPX. Let me put... I want candles. And what happened to the SPX back in November, October? Broke out of its base. And same thing here. Up and up and up and up. Okay, I'm going to minimize that for now. Whew, adios. So the DAX, nice, beautiful stage 2 from there. A little quirk here that would have triggered you out. Close below 12-month moving average. Don't want to go long. But as soon as the price action went back above, if the weight of evidence, if everything was still in favor, you would have got back in on the train, and then you would have rode this all the way up here. 95. And 95, look at that. 95. What happened in 95? Check it out. In 95, we had reserve rates that were thrown out the windows. Fractional reserves. Right here. So right here, 96. Coincidence or explosion? Let's go back. I have to get exactly the date. Whoa. Let's make it big. No. What did you do, Pat? I wanted to, make it like that. So this is the SPX. And you see that 95, 96. Maybe I think it's maybe early 95. That fractional reserve was out the window. And then after that, off it went. Lots of cash going everywhere. Everybody's having fun. Same here, 95, 96. Broke out, all that money coming in. Everybody joining the party. All right. And here, 2000, 2001, down. Getting far away from the 12-month moving average. Sideways move, break below. Horizontal breakout line. Breakdown line. Close back above. You're still, the 12-month moving average is still going upwards, so you're not going to short yet. So you're going to actually wait for a bigger pattern, which will probably form. And after that, is the 12-month moving average going down here? No, right here, the month after, this month here, 12 months average was going down. This was the candle that did it. No, still going up. Breakdown, pull back here, close toward the 12-month average, and then down. Very, very nice deconstruction. And now remember, the more the price action is below the 12-month average. Another nice pullback here, close towards the 12-month average. Pull back, go down, pull back. Oh, this would have triggered you out right here, close above. And after when the close back down below, you would have looked for a continuation short if the opportunity was still there. And then after you would have went down. So a few opportunities to add or enter short here, close towards support and outturn resistance, a declining 12-month moving average. If you get whipsawed out here, you're out. And then the next month, you might be able to get back in if the weight of evidence, if everything else still in favor. When you get that close below that 1, 2, 3, 4 month sideways move, then you could get in. But the further you're way down, the less and less, the better it is to load up here in the top sector. And the further you're way down, the less probable, the less fruits you'll get from that investment, from that risk. And down it goes. Trend line 1, 2, 3. Well, you exit here, right? So that's your final call. If you had a trend line valuation before, good, half your position out, or else everything you're out if you close above the 12-month average. See, it didn't come back down, didn't continue like here. So here you stop, and that's your gains. You loaded up here, maybe here, and you rolled that all the way down. Look at that beautiful stage 2, guys. Whoa, that was nice. So you ride it bear, and then after that you change your mind, and then you ride it bull, and then you maximize money. Instead of buying and holding and waiting for years, going down and stressing, and after that getting disgusted with the markets and not wanting to participate anymore, you ride. That's the beauty of Stan Weinstein stage analysis. You get to ride this multi-year down, loading up at the beginning, maybe halfway through, and unloading down here. When the 12-month average, see it, you don't go long until the 12-month average in the weight of evidence at least is starting to go up. So once it starts going up, you look for a horizontal breakout line. Here you have it right here, inclining 12-month average. Then, of course, I look at the economic data, see if the unemployment is super high. Then that's the fuel you have, because when the price action goes up, as the economy gets better, they're pricing that in. The unemployment starts going down. That's your fuel for rising up. If you're down here and the unemployment's super low, you're not this. I would trust this less, and I believe that it keep going down. You keep going down until unemployment reaches high levels, and that's your fuel to go back up, guys. Can I compare it? Let's add it. Let's add the... I don't have the German unemployment rate. Oh. And you see it here. Bye-bye, SPX. You've served me well, but I do not need you anymore. And you see here the fuel. Where's the fuel, Pat? Where's the fuel? I need vertical lines. Right here. Oh, no. Right here. So as you broke up above, you see the 12 months, the unemployment rate was plateauing, getting high, starting to decrease, and that's your fuel. So now it's this, everything's going better. Unemployment rate is going down until you reach the top here. Same thing here. Whoa, when we had our breakdown. Okay, this is the first one here, around the pullback. You see how the employment is super low and starting to go back up. That's what you see at tops, guys. That's why whatever is happening right now in 2019 on the markets, my weight of evidence, because of this, I can't, in good conscience, play in an uptrend. Just because of this indicator, it's we're at 4%. It's starting to climb up actually. So we had, I think, a low at 3.6 or 3.7. We're back at 3, or we're at 3.8, the lowest. It went up 3.9, 4, and I'm waiting for the next reading. If it's 4.1, for me, it's going to be start curving up and coinciding with the top we had. I'll just try to find the best entry below a support and resistance, below close to a 12-month moving average, and I'll be happy with that short. That'll be my first short, and then I'll add on when I get those pullbacks close towards horizontal breakdown lines, turn resistance and 12-month moving average, and try to add good at the beginning. And then when fear gets in and everything starts falling fast, and you're away from the 12-month moving average, and you can't get good entries because you're in a far away region from 12-month moving average, you could pull back at any time. I'll just enjoy the ride all the way down until I exit when I close above the 12-month moving average. So you see, even the US, so the DAX and the SPX, the US markets, are very closely linked. We saw it in 95 or late with maybe a delay effect of fractional reserves going out the window. And we saw it in 82, November, 1 month after the US markets started exploding. We saw how the DAX exploded. So it's like, it looks more like the SPX or the American markets than the FTSE did. The FTSE did not follow, did not get new highs as much as the SPX did. And down we go, and look at that beautiful stage 2. Let me just see how that would have panned out. Enter here. Oh, here, close below, you're out. It happens. But after that, if everything's still good, and employment rate is still going downwards, you still have fuel in the gas tank, you get in here, and then you enter here on the pullbacks, go away, enter here on those pullbacks. Another break continuation pattern, go out, and you exit here. This is your final call. Your 12-month moving average, you're out. And then after that, if you look at, hey, cool. You even start seeing here that the unemployment rate is starting to go back upwards. You even had some signs here that this type of situation could have been imminent, but now with the weight of evidence, monthly defined breakdown, unemployment rate starting going upwards. You have to flip your idea, say, no, I'm not bull anymore. Yes, some crazy thing could have a crazy wick, crazy extenuation candle up there, but I'm going to have a better risk to reward environment right there. So you exit here, pull back to breakdown line, turn the resistance, 12-month average, great short entry here, sideways move, and down you go, and you ride that all the way down until you exit right here. And what happens by that time? Well, you see it. Unemployment rate went back up. They get that fuel, and now we had the fuel for the crazy, crazy rally. Where's my 12-month moving average going upwards? Right here. 12-month moving average trying to go upwards. We're closing above a horizontal breakout line. And then off you go. You have that fuel. Ooh. Okay, 2011, had a hard time here. You would have exited. And you would have exited. Yeah, that one would have been a hard one. They don't always work out when they whipsaw like that. But you try to get in and hopefully you get to ride these long stage 2s. So for the DAX, you would have been stuck. You couldn't have shorted here because you don't have that fuel, weight of evidence. So you wait. When you get back in, then you would have entered later on. You still had some fuel. Oh, had a hard time, man. European markets not as good as giving earlier signs of problems, way ahead of the US markets. And that's where we are today, guys. Wow. Okay, so this would have been mayhem right here. A lot of chop. And where are we today, guys? So are we going to get a nice stage 4 decline? Here's the top pattern, declining 12-month moving average, very nice top. Even it looks like a small head and shoulders on the monthly candle chart. We have that fuel. Remember the fuel? Give me fuel. Give me fire. Right here. Whoa. Move that here. Give me. Here. Right here. So right now, it's the whole situation, the weight of evidence. Sure, we could have some turbulence here. But right now, I have a lot of fuel. I'm at ultra low unemployment rate. It's starting to creep up. If it goes up a little bit more, combine that with a declining 12-month average, a monthly candle chart breakdown. Right here, we could have an opportunity to enter short if it starts rolling over, guys. So another DAX, man, another European market broke down for the American markets. October, pulling back, but look, you're not lower highs. When you look at the daily chart, you see crazy rallies, you see 8-week rallies, but when you take a step back, you're in a downtrend. Lower lows, lower highs, downtrend, 12-month average. You got the fuel here, unemployment rate, the economy. It's saturated, overheated, and now it needs to reset. And after that, we'll be ready for another leg down, guys. Woo! Wow. All right. That's it for me. The DAX, stage 4, downtrend. All right. Who's next on the list? I guess I'll find out tomorrow. Thanks, guys. Ciao.